Thank you for standing by and welcome to the AFS Best Practices webinar. Our topic today is Pricing Fundamentals, a review of the second quarter commercial lending. This webinar will be approximately an hour long, and our speakers today are from our AFS Business Intelligence team, Don Doherty, Jeremy Charlson, and Rob Lynch. We are recording today's session, and therefore this call is in listen-only mode. We do encourage questions. Jeremy, if you would advance to the next slide, you will see the area that we are showing on this slide, the right-hand side of your screen. Please use the question window to ask your questions. We will leave time at the end of the presentation so that we may answer as many questions as possible. You will receive an email tomorrow with a link to listen or download the presentation. Thank you for joining us today. Don?
Thank you, Renee. Good afternoon, everyone, or good morning. And welcome to our webinar. We here at AFS hope you, your families, and your coworkers are doing well in these very challenging times. As we get started, I want to say that we certainly welcome any comments any of you may have on today's webinar. As Renee said, use the chat area. And also our contact information is provided at the end of this presentation. So please do not hesitate to reach out to us with your questions. It is worth noting that the source of the data presenting today is from the AFS Pricing Service. This database is the industry source for pricing trends for commercial lending and contains over $1 trillion in commitments, with approximately 80,000 new and renewed loans being added to our database each quarter. This database is also used to prepare our monthly pricing trends newsletter. Again, please reach out to us if you are interested in learning more about our pricing service or if you are interested in receiving our monthly newsletter. Moving to slide 4, today we will be reviewing results through 2Q with a focus on loan growth, followed by Rob Lynch looking at pricing and fees. And to round out today's webcast, Jeremy Charlson will provide valuable insights on risk and return. To get started, we move to slide 5 and provide some context for the business and economic environment banks are currently operating in. Following a record-long expansion, the U.S. economy officially entered into a recession in February of this year. Looking at the top left chart, we can see that real GDP decreased 5% on an annualized basis in the first quarter. While the second quarter results are not yet available, a tracking model used by the Atlanta Fed predicts that the economy will contract an unprecedented 34.7% in the second quarter. Moving to the top right, we have the national unemployment rate. Unemployment fell slightly in May and again in June as states rolled back restrictions designed to contain the pandemic. However, at a rate of 11.1%, unemployment in June was far above the low levels we saw at the start of the year. The bottom left chart illustrates the 10-year Treasury yield, which in June was trending close to the all-time historical low point. The low yield is due to investors seeking safe havens in response to uncertainty created by the pandemic. Finally, on the bottom right, we see the Industrial Production Index, which is analogous to a GDP-type measure for the manufacturing sector. Growth in this sector was already on shaky footing before COVID-19 due to the trade war and other headwinds. The impact of the virus clearly pushed this sector of the economy lower during 2Q. All 4 of these economic indicators paint a gloomy outlook for commercial loan growth, and more than ever, banks will have to be certain that they are pricing adequately for the credit risk in their loan portfolios. More on this last point later in today's webcast. On slide 6, we have an American Banker article with a cautious view for loan growth. Earlier this month, banks began disclosing their second quarter earnings and loan loss provisions. According to preliminary results, reserves have quadrupled on average through the first 6 months of 2020, meaning that banks are bracing for significant loan losses ahead. This underscores just how deeply COVID-19 has impacted the economy. Total loan growth for the banking industry, both consumer and commercial, is likely to be tepid at best once the results for all of the banks are in. This article cautions readers that any net new loan growth banks report in 2Q is likely to be tied predominantly to the Paycheck Protection Program, or PPP. With demand having slowed for PPP loans, banks will be hard-pressed to find credit-worthy borrowers, particularly in populated states that have already paused their reopening plans and are bracing for a severe economic contraction. But that doesn't mean opportunities still don't exist in the commercial loan market. The article mentions that some industries or niche lending segments are likely to recover faster than others. One of the consistent themes in our webinar series is that even during periods of general economic stress, there are some industries and geographic areas with favorable risk-return characteristics. Throughout today's webcast, we'll examine where such opportunities might exist. As we move into the loan growth section of today's webcast, we talk about unprecedented growth when describing the trend in C&I loan growth that we saw in early March. In March, corporate borrowers drew heavily on lines of credit in order to stockpile cash and brace for supply chain disruptions. C&I loan balances continued to expand in April and May, driven by an influx of PPP loans. But the loan market turned dramatically in June. According to the Fed's H8 release, which includes PPP loans, C&I loan balances fell 51.6% on an annualized basis in June, representing the sharpest month-over-month contraction ever recorded. Again, the operative word here is unprecedented. There were a number of reasons for this sharp reversal. One driver was that PPP loan volume plateaued in June, and new PPP activity was insufficient to carry the market like it did in April and into May. The economic recession deepened throughout the second quarter, and by June, the prospect of a V-shaped recovery seemed more and more unlikely. Banks began to focus not on growing new loans, but rather on preserving capital for what is likely to be a volatile second half of the year. Moving to slide 9, we look at the quarter-over-quarter loan growth for the second quarter. A quick housekeeping comment. From this point forward, we have excluded PPP loans from the charts being presented today. Following the unprecedented growth we saw at the end of 1Q20, where companies raced to build a liquidity cushion to manage through these trying times, the second quarter, quarter-over-quarter loan growth rate for all loan types plummeted to a negative 5.26%. The chart on the right shows only CRE bilateral loans in 2Q20 were higher quarter-over-quarter, with a modest increase of a little more than 1%. C&I bilateral loans were down more than 4%, and participations in syndications dropped sharply, down almost 11%. During 2Q20, balances dropped sharply in the wholesale trade and retail trade sectors. On slide 10, we look across the months in 2Q and show the month-over-month growth rates. The decrease in June's total commercial loan balances, negative 2.63%, represents the largest month-over-month reduction in our database. Again, we see very modest CRE bilateral loan growth for April, May, and June. However, for C&I bilateral loans and participations in syndications, balances decreased each month during 2Q, with June's month-over-month rate of minus 1.74% for C&I bilateral loans and a negative 5.78 for participations and syndications, which together were responsible for the sharpest month-over-month contraction we have seen. Next, on slide 11, we change our focus and look at year-over-year and year-to-date loan growth. Although balances fell dramatically during 2Q, balances are still higher than last June, up 4.65%, and balances are also higher than year-end 2019, up more than 3%. Benefiting from a strong first quarter, where much of the growth was driven by withdrawals under existing lines of credit and an influx of new lending, some industry sectors, such as real estate, transportation and warehousing, and healthcare, continue to report higher year-to-date balances. On this slide, we can see that large C&I bilateral loans, CRE bilateral loans, large C&I participations, and CRE participations all contributed to the higher year-to-date balances. As we move to slide 12, we present a quadrant view showing differences in loan growth by state. The top left chart focuses on the year-to-date growth for all loan types and presents the top 5 and bottom 5 states. At first glance, we notice that each of the top 5 states are states that have been hard hit by COVID-19. Borrowers under distress in these states are carrying higher line of credit utilization rates, which has contributed to higher loan balances. California is the only state to appear in the top 5 for every loan type. In addition to higher CRE balances, California also saw higher C&I bilateral balances in the finance and insurance sector, higher participation balances in both the real estate sector and in the manufacturing sector focused on computer and electronic products and transportation equipment. At the other end of the spectrum, balances in Louisiana decreased by 10% because of lower balances in wholesale trade subsectors of merchant wholesalers for durable goods and non-durable goods. Moving to slide 13, one of the leading indicators for commercial loan growth is real GDP. For the last several years, the 10 largest CBSAs in terms of real GDP significantly outpaced the rest of the country for commercial loan growth. In other words, cities with the highest levels of economic activity and growth tended to generate the highest levels of commercial loan growth. We have presented this slide in previous webinars using a December 2015 baseline to measure growth in outstandings. For today's presentation, we move the baseline up 3 years to see what the growth has been over the last year and a half. During this time, the top 10 CBSAs have significantly outperformed the rest of the country. In addition, despite the drop in loan balances being broad-based geographically during the second quarter, the decline for the top 10 CBSAs was not as steep as the all other regions segment. It will be interesting to see in the coming months if the rest of the country moves closer to the growth rate of the top 10 CBSAs or the top 10 CBSAs move closer to the rest of the country. We know that our pricing service has the data to help you find where opportunities exist in today's ever-changing markets. As we move forward to slide 14, we often see a strong correlation between loan growth and particular industry sectors. Here we see the arts, entertainment, and recreation sector led total balance growth for the first half of the year. One reason year-to-date balances are higher can be attributed to continued higher line of credit utilization rates for this sector during 2Q. June's rate of 53% is still up 16% from December. As a result, New York, Las Vegas, and Los Angeles all reported higher year-to-date balances in this sector. Healthcare ranked highest for year-to-date C&I bilateral loan growth. Over the first 6 months of the year, balances remained high for the hospital subsector, specifically for general medical and surgical hospitals. In addition, the subsectors for continuing care retirement communities and assisted living and offices of dentists also contributed to healthcare's year-to-date balance growth. The manufacturing sector led total balance growth in the first quarter. This sector had struggled last year due to the trade war and other headwinds. During the first 6 months of the year, manufacturing borrowers have faced added pressure in the form of supply chain disruptions caused by COVID-19. However, for participations on the bottom right, the manufacturing sector focused on wood and chemical products continues to report higher balances through 2Q20. Here, two subsectors, chemical manufacturing and pharmaceutical and medicine manufacturing, contributed to these higher loan balances. On the next couple slides, we'll look at some of the factors that have a direct correlation on balance growth. That is line of credit utilization and new and renewed loan volumes. Slide 15 looks at line of credit utilization rates across industries using the two-digit NAICS codes. Last quarter, the growth in total balances during March was fueled by an increase in line utilization. In June, utilization rates were down from the March peak across every industry except the mining, oil, and gas sector. Consequently, the overall line utilization rate in June was down from March's rate of 46% to 36.9%, which is very much back in line with December's 36.3% rate. This overall drop in utilization rates contributed to the lower loan balances in the second quarter. However, looking to the far right on this chart, two sectors continuing to display elevated line utilization rates are arts, entertainment and recreation, and accommodation and food services. While utilization is down from the prior quarter for both sectors, rates remain well above the level seen prior to the pandemic. Higher line utilization is one proxy for credit distress, as borrowers tend to tap lines of credit when they have an urgent need for cash. These two sectors have been hit especially hard by the restrictions designed to curtail the virus spread. So it is not surprising that line utilization remains elevated for these two industries. On the next slide, another factor contributing to overall loan growth is the impact of new and renewed balances. Although new volume ticked up in June when compared to June of last year, originations are down 26%. New loans for C&I bilateral loans, CRE bilateral loans, and participations were all significantly lower than last June. Renewed volume also fell in June from last month and is 11% lower than the level seen in June of last year. In aggregate, new and renewed loan balances are down 20% this June compared to last June, which also helps to shed some light on why commercial loan growth fell during 2Q. And now we will transition into the pricing and fee segment of today's webcast. With that, I am turning it over to you, Rob.
All right. Thank you, Don. Good afternoon, everyone. In looking at the pricing for the new and renewed loans, we see that the interest rate declines experienced over the last few months have begun to level off, and in some cases, they actually increased slightly in June. This is the case across all loan types, which you can see by the similarity in all four of these charts. The 10-year Treasury yield, noted by the dashed black line in these charts, shows the same pattern. In the lower left chart, new CRE bilateral loans, shown by the blue line, ticked up the most this month and are close to 3%, while participations in C&I bilateral loans, the right-hand charts, are closer to 2.5%. On the next slide is a heat map for C&I bilateral loans. This chart is designed to show the range of interest rates across the country. In this depiction, interest rates are broken into quartiles, the darkest colored states having the highest interest rates and the lighter colored states being the lowest. You can see the Northeast and middle Atlantic areas are clustered around the first and second quartiles. Many of the Midwestern states are showing a lower than average rate, with the exception of Iowa, which saw a higher rate in the healthcare sector. Louisiana, Oklahoma, and New Mexico are states that are in the higher ranges as well. In these states, construction, accommodation, entertainment, and food, as well as healthcare, were the main drivers. Next, we show the same heat map, only this time for participations and syndications. For these transactions, we see the Northeast is not in the upper levels of interest rates, but the Midwestern states are. And once again, Louisiana, Oklahoma, and New Mexico are in the first quartile. This is primarily due to the mining and transportation and retail and wholesale trade sectors. Next, let's take a look at interest rates by industry. In these two charts, we look at interest rates over the last 18 months, split into 6-month intervals, namely January through June of 2019, represented by the green bar, July through December 2019, represented by the orange bar, and January through June 2020, represented by the blue bar. As you can see in all industry sectors, interest rates have declined over these time periods, both for bilateral loans in the left-hand chart and participations in the right-hand chart. What is interesting to note is that the healthcare sector, an area of growth this year, had the largest decrease in interest rates over these time periods. It was slightly more than 2% for C&I bilateral loans, as well as participations. So we've seen over the last 18 months that interest rates have been trending down. So what have banks been doing to help themselves during this time? Well, the prevailing trend at this point is to introduce floor rates into transactions. On this slide, in the left-hand chart, we can see a steady increase in the use of floors during the second quarter. Here, the blue bar represents new and renewed LIBOR loans with a floor as a percentage of all new and renewed LIBOR loans. And the orange bar represents new and renewed prime-based loans with a floor as a percentage of all new and renewed prime-based loans. You can see that the number of LIBOR loans with a floor in June doubled from the amount in April, going from 10% to over 20%. Prime-based loans also increased by more than 10%, going from just under 40% in April 2020 to just over 50% in June. The chart on the right shows the performance of the LIBOR and prime-based loans at the floor. So the bars represent the percentage of LIBOR and prime-based loans that are priced at the floor in these months. The green line is the average floor interest rate for LIBOR-based loans, and the red line is the average floor interest rate for the prime-based loans. Looking at the bars, you see that the percentage of LIBOR-based loans priced at the floor has increased in these 3 months, while the percentage of prime-based loans has decreased slightly. Both indices are close to having 60% of loans priced at a floor. And essentially, banks are getting more aggressive with instituting floors into the pricing mix, and this is helping to keep interest rates steady. This helps explain the leveling off of the interest rates this month that was shown in the first slide of this section. Fees are also a source of income for banks. And on this next slide, we can see that fee incidence in the upper left-hand corner is holding relatively steady the last 2 months, while the fee level in the upper right-hand chart has gone down for both new and renewed loans. Comparing June 2020 to June 2019, only fee level on renewals increased by a small amount, while fee level on new loans has decreased. Fee incidence for both new and renewed loans decreased when comparing June 2020 to June 2019. When looking at fees by industries, we can see that in comparing June 2020 and June 2019, most industries are showing small decreases in fee incidence and fee level, with mining and transportation showing a slight increase in fee incidence, but that industry also had the largest decrease in fee level. So with that, I will turn the presentation over to Jeremy Charlson, who will discuss the risk and return dynamics. Jeremy?
All right, great. Thank you, Rob. And just a quick sound check. Renee, can you hear me okay?
Sorry, Jeremy. Yes, I can hear you. Yep, we can hear you. Thank you.
All right, perfect. Thanks for that. All right, and thank you, Rob, for the overview on pricing and fees. So what we'd like to do now as the final layer of this analysis is look at pricing trends, this time in the context of credit risk. So from a credit risk standpoint, the second quarter has been one of turmoil, to say the least. The advent and spread of COVID-19 has introduced market volatility not seen since the Great Recession. And while deterioration in conventional indicators of credit risk has been relatively modest through June, banks are bracing for significant losses ahead, as evidenced by the significant reserve bills that we saw through the first 6 months of 2020. So in light of this evolving situation, we wanted to see if we could discern any signs of risk migration in our commercial loan database. And what we have plotted here is a risk rating distribution of all commercial loans, excluding the PPP loans. In order to ensure comparability in the data set, we aligned the unique risk rating systems of all the participating banks to the RMA obligor risk rating scale, which is displayed on the x-axis of this distribution. So the first 4 ratings of this scale correspond to investment grade loans. And note that here, we're using the Fed's CCAR definition for investment grade loans, which are defined as loans with a credit rating higher than and including BBB. On a percentage basis, investment grade commercial loans decreased in June when compared to the same month a year earlier. You can see how the bars through risk ratings 1 through 4, the orange series is beneath the blue bars. Over the same period, we saw the percentage of commercial loans adversely rated criticized nearly double. That's ratings 7 through 10, and you can see a subset chart there in the top right showing just how dramatically criticized balances have risen over the last year. Now, one reason for the year-over-year decline in investment grade loans could be that higher quality borrowers and those with fairly decent liquidity paid down debt in recent months. But the growth in criticized loans that we're seeing over the period likely reflects risk rating downgrades as banks brace for potential credit problems in the year ahead. So at a deeper level, what sectors are driving the increase that we're seeing in non-investment grade loans? And on this slide here, we take the 5 largest NAICS subsectors with the largest shift in total balances from investment grade to non-investment grade. It's no coincidence the 5 industries you see here, things like water, transportation, oil and gas, all 5 of these industries were heavily impacted in a bad way by COVID-19. Year over year, it was water transportation, second from the left there, that experienced the largest shift in its risk rating composition, with 41% of the outstandings migrating from investment grade to non-investment grade. In terms of the activities in water transportation, that includes both commercial and passenger transportation. So companies in this industry have been hit really hard and been hurt very badly by the recent travel restrictions, as well as the general slowdown in economic and commercial activity. As of June, approximately 90%, which is a pretty large ratio, 90% of the total outstandings in water transportation were risk-rated non-investment grade. We see a similar split for 3 other industries on this chart, those being furniture stores, apparel manufacturing, and oil and gas extraction on the far right, all of which saw close to about 90% of their total outstandings being risk-rated investment grade in the latest month. The trend for oil and gas really is no surprise. Borrowers in the oil and gas sector have had to contend not only with low oil demand due to the travel restrictions in COVID-19, but also with a supply glut that briefly pushed prices into negative territory in April, so getting hit hard on both the demand and supply side in that particular sector. Now, one of the non-investment grade categories on that obligor risk rating scale we showed earlier is special mention. And special mention is a regulatory classification that's basically defined as an asset that has potential weakness and one that deserves management's close attention. Now, special mention status doesn't necessarily mean that the borrower in question is in trouble, but it does indicate that the potential for default has recently and meaningfully increased. Similar to the reason for why banks have increased provisions this past quarter, some banks are taking a more cautious and prudent approach and are downgrading borrowers in problem industries or geographies to special mention status, really to get ahead of the curve in anticipation of some problems that might arise later this year. When thinking about high-risk industries, subsectors with the largest increases in special mention loans represent areas in which banks believe COVID-19 is likely to have the most adverse credit impact. The 10 industries plotted here experienced the largest year-over-year increase in special mention loans. And we already highlighted on the last slide water transportation, which was the industry with the biggest increase in special mention. Again, all the headwinds in that sector contributing to that trend. But there's a couple of other really interesting industries here. If you look third and fourth from the right, we have accommodation, which is your hotels and motels, and miscellaneous store retailers. And what's fascinating here is that a year ago, special mention loans made up less than 1% of all the outstandings in these two particular subsectors. But by June of this year, special mention loans had risen to the point where now they're 25% of the volume for hotels and 17% of the volume for miscellaneous retailers. So really dramatic increases just over the last year. There's also been a lot written about the airlines industry and the impact COVID-19 has had on that industry. It's interesting that even before the crisis, if you look in the middle of the graph where it says air transportation, even before the crisis, credit quality was not quite as pristine for this industry as it was for many other sectors. A year ago, special mention loans made up about 19% of all the outstandings for air transportation, and now it's since risen to a ratio of 34%, a little over more than 1/3 of the outstandings of all the loans in this year. So really an industry hit pretty hard. I would not be surprised to see that ratio grow even more so in the next few months. With the percentage of risky loans rising across several industries, banks as a whole are reportedly tightening standards on C&I loans. The chart you see here is actually from the Federal Reserve's latest Senior Loan Officer Opinion Survey, and it illustrates the demand for credit versus banks' willingness to extend credit. When that orange series is above the x-axis, that means that borrower demand for C&I loans has increased as of late. And we can see that as of the latest survey, demand for C&I loans has indeed increased as many companies are facing a liquidity crunch due to the economic shutdowns in many cities and many states. You'll notice that that blue line, the supply of credit, is beneath the horizontal axes. That means that banks on average tighten standards for commercial loans and reduce the supply of credit. So while there are more companies out there that are willing to borrow and in need of a C&I loan, banks on balance have become much more selective. This is a disconnect that we really haven't seen in several years and is yet another manifestation of the current economic crisis. One of the ways in our data that we're seeing banks tighten standards is through spread pricing. Weighted average LIBOR equivalent spreads were up in June from last month for both investment grade and non-investment grade loans. You can see that trend there for the solid lines on this diagram. On a year-over-year basis, spread pricing increases were even more pronounced for these two risk segments, with spreads on non-investment grade loans widening a little bit more than the investment grade sample over this period. But again, they're both up year over year. We also plotted the 10-year Treasury yield as the dotted black series, which provides another interesting perspective on bank pricing and risk standards. You can think of the difference between the weighted average LIBOR equivalent spread and the 10-year Treasury as a type of risk premium, where a larger difference indicates a smaller tolerance for credit risk. That difference has widened significantly over the last year, whether we compare the 10-year Treasury to investment grade or non-investment grade loans. So again, from a pricing perspective, it does appear that banks have indeed tightened standards on the commercial loans they book. Another way that we can measure risk and return is to examine the difference between the weighted average LIBOR equivalent spread and the weighted average expected loss. We call this difference the risk return margin, and essentially this difference is equivalent to a return on equity for an individual obligation. The larger this difference, the larger the gap between that blue series, the spread, and the red series, the expected loss, the larger that difference, the more banks are earning for a given level of credit risk. The risk-return margin narrows when spread pricing decreases and/or expected losses increase. So on this diagram, if you look back to January of this year, the weighted average, the risk-return margin, the difference between the blue and the red series, was 163 basis points in January 2020. From January to June, the weighted average LIBOR equivalent spread for commercial loans did increase. That blue line is going up, or that blue dot is increasing. However, the red series, the expected losses, increased by an even larger amount. The result was that the risk-return margin narrowed 22 basis points from January to June of this year. That's actually somewhat opposed to the Fed survey that said banks are tightening standards. The implication on this chart is that while banks are increasing spreads are widening, spread pricing has not been able to keep pace with increases in expected losses. Now, of course, risk-return trends are not uniform across the industry spectrum. I think Don alluded to earlier in this presentation that even during periods of economic stress, even during times when the overall market's deteriorating, there's always some opportunities, some industries or geographies where risk-return characteristics are still favorable. And here we plot the risk-return margin, that difference between the spread and the expected loss, for the 10 largest subsectors in terms of June new renewed volume. Contrary to the market trend, the risk-return margin actually widened across 5 of the industries depicted on this particular graph. And of these 5, funds, trusts, and financial vehicles, a finance and insurance sector, which is pictured, I believe, third from the right, that was the subsector that actually displayed the largest increase in its margin. It actually widened from 157 basis points to 204 from January to June, so a really big increase in terms of risk and return. Now, subsectors that experienced a narrowing or an erosion in risk and return were oil and gas extraction, merchant wholesalers of durable goods, and credit intermediation. We really weren't surprised to see the risk-return margin narrow for oil and gas. You can see oil and gas second from the left here on this chart. Again, that industry has faced an abundance of headwinds so far in 2020. Prices at one point were negative, so not surprising that banks have increased their expected loss projections for that sector. What did catch us a bit more off guard was the trend for credit intermediation, which is about pictured here in about the middle of the graph. Credit intermediation has been a sector we've had our eye on for a while now. It's one where C&I lending has increased quite a bit over the last few years. Credit intermediation, it's kind of a weird name for the sector, but really it covers lending to non-bank intermediaries, non-depository institutions, and it even has some borrowers there that buy and issue CLOs. And we've seen commercial bank lending to those intermediaries rise quite a bit over the last few years. And it appears that as liquidity dries up in the marketplace, many of these non-bank intermediaries are facing an increasingly gloomy credit outlook. The ELs in that sector have risen quite substantially from January, really eroding the risk-return margin for this particular sector. Another way of visualizing the industry risk-return profiles is to plot them on a scatter plot. Doing so allows us to categorize the sectors relative to favorable and unfavorable quadrants. A lot of the banks we work with like this kind of view. So the best quadrant to be in on this diagram is in the top left, in which the industries display low expected losses and high weighted average LIBOR equivalent spreads, so high pricing, low risk. The reverse can be said for the bottom right quadrant. 3 industries, namely real estate, construction, and professional scientific and technical services, fall within the best quadrant in the top left, with funds, trusts, and financial vehicles, as well as securities and commodity contracts, straddling the border of this particular quadrant. Conversely, we mentioned how credit intermediation is not showing very favorable trends as of late. You can see that credit intermediation is falling in the worst subsector in the bottom right, where it has a lower spread on a weaker quality loan mix. A couple of months ago, we worked with a top 10 bank to create a similar diagram like this for their industry and product mix. This particular bank was looking to divest of low performing assets, meaning those with low returns and high projected expected losses. And using our benchmarking data, this bank was able to see which industries were showing superior risk return characteristics for the market and then reallocate accordingly. We can perform a similar risk return analysis, this time stratifying the results by geography. And on this slide, we examine the difference between LIBOR equivalent spread and expected losses for the top 10 CBSAs in terms of real GDP. We know from working with all the banks here on the line today that even when you account for variables like deal size and industry, some geographies are just more competitive than others when it comes to loan pricing. Moreover, some geographic regions and some cities have been impacted more severely than others by COVID-19. So take Chicago, for instance, which is plotted fourth from the left on this diagram. Over the last 6 months, this metro reported a really large increase in unemployment, one that was much sharper in rate than what we saw at the national average level. We know from a lot of research we've done that indicators like unemployment, GDP, anything like and consumer spending, all those variables correlate really strongly with commercial loan credit quality. So from January to June, if you look at the red series for Chicago, the expected losses surged in Chicago over this period, which really narrowed the risk return margin for this particular sector. So it could very well be that the rise in unemployment, a lot of other economic struggles the city's having right now, that may have strongly correlated with the increase that we're seeing in the expected loss ratio. Now contrast Chicago with, say, San Francisco, which is illustrated second from the right on this chart. In San Francisco, spread pricing actually increased significantly in June from the start of the year, while expected losses really didn't change very much. They held pretty steady from the start of the year. So the result is that San Francisco displays a much wider return relative to risk than what we're seeing for the national average. Again, these profiles certainly do vary by geography. It shows you the importance of stratifying the market trend by industry and geography to really get you the analytics at a deeper level. Then using a slightly different layout, going back to our scatter plot here, we have expected loss on the horizontal axes and LIBOR equivalent spread on the Y. We can see that two CBSAs, those being San Francisco and Philadelphia, both display favorable risk return profiles in June. Both metros fall within the top left quadrant where spread pricing is higher and expected losses are lower versus national averages. In the opposite quadrant, we can see that Atlanta and Washington, D.C., that dark green and red bubble in the bottom right, both of those CBSAs have higher risk and lower pricing than national averages as of June. What caught my eye here is that several other metros are clustered really close together on the left-hand side of this page. So metros like New York, Houston, and LA and Boston, they're all really clustered very close together. One of the things that we saw during the last downturn in 2008, 2009 was that as the recession progressed, more markets tended to spread out. So some markets recovered very quickly, some continued to deteriorate at a pretty rapid pace. So it'll be interesting to see over the next few months if CBSAs like New York and Houston start to spread out more on this risk return plane as we have a better sense for how the economy is going to look in the months ahead. So as we reflect on the outlook for the remainder of the year, we definitely see a very challenging environment for commercial banks. When the GDP results come in for 2Q, the numbers for the second quarter are likely to show one of the deepest economic contractions ever experienced. Mirroring the economic trends, total commercial loan balances plummeted in June of this year. And as Don said, that was the sharpest month-over-month drop we ever saw recorded. Going back all the way to 1947, actually, it was that dramatic. Outside of PPP loans, new renewed deal flow was pretty weak in 2Q compared to the levels seen a year ago. So again, not a lot of volume there to boost the total outstandings. A piece of good news, though, this quarter was that pricing did stabilize in the second quarter as banks appear to be getting more aggressive with the use of interest rate floors. And we also saw loan spreads widen in June from a year ago. However, increases in loan spreads, increases in spread pricing, they were more than offset by increases in expected loss, meaning that risk return on average is eroding for commercial loans. Among the sectors with the most pronounced credit deterioration, among those with big increases in special mention loans and expected losses are accommodation, which is hotels and motels, miscellaneous store retailers, as well as water transportation. All three of those industries showing a really pronounced deterioration. But we should note these are not the only areas of weakness that we're seeing in the market. So as we move to the second half of the year, banks will need to be very vigilant this year to ensure that they're pricing adequately for the credit risk in their portfolios. So before we take questions, I just want to reiterate that AFS is definitely here to help you, whether it's on the loan system side. I know a lot of the banks we've worked with, we've helped them a lot with questions around SOFR, processing PPP loans. On the analytics side here in our BI department, trying to help banks figure out where some opportunities might be. We definitely want to partner with you to ensure that as the year unfolds, you can be as successful as possible. We really appreciate you joining us for the webinar today and for all the banks that contribute data to the pricing dashboard database. And I think with that, we'll take a moment here to collect any questions that we may have from the audience. And Renee, if you're on the line, I'm looking for the chat area here. Are you able to see the chat panel or questions?
I am, Jeremy. It looks like we don't have any questions today. I think you all covered the data pretty thoroughly, that there don't appear to be any questions today.
Okay. Well, our contact information here is listed on this slide. If you do have any questions about the pricing dashboard service, which is our vehicle for delivering the information to the banks, or if any of the charts here caught your eye and you have any questions, again, we love to have those discussions with banks. Please feel free to reach out to us. We're definitely interested in your feedback in terms of how we can improve these webinars going forward. Again, no, it's really busy times for all the banks, so thank you so much for joining us today. We really appreciate it.
Thanks, Jeremy. And as a reminder to everyone on the line, we will be sending out an email tomorrow with a link so that you may listen and or download the presentation material. Thank you, everyone, and have a good day.
Thank you, Renee.